Hey everyone, this is Kirk here again at OptionAlpha.com, where we show you guys how to make smarter trades. And today we're actually going to go over all of the trades that we made on Friday before the long Labor Day weekend. But before I do that, I wanted to let you guys know as members about our new webinar and group coaching that's going to be coming up in the next 7 days. So there's actually less than 7 days to sign up for this. You guys are the absolute first ones I'm letting know about this. And so I just wanted to open up this opportunity for you guys in advance of sending out an email to our huge newsletter list. And undoubtedly, it's going to sell out very, very quickly. It's possibly one of the bigger group coaching webinars that we're going to do, only because the topic is so huge, and that is adjusting trades. So all you have to do is you have to go to optionalpha.com/webinars, or you can go at any page on the website and click on this webinars link at the top. It will take you to this page that shows you when our next webinar is launching. And like I said, this is the next webinar. It is all about trade adjustments. It's probably going to be an hour to an hour and a half webinar. And I'm having 2 sessions of this webinar. So you don't have to sign up for both unless you want to come to both. But we're having 2 completely different sessions. So I know there's going to be a lot of people that are going to want to join in on this. That's why I'm opening up to 2 different sessions for the exact same topic. Usually what we do with these group coaching and webinars before is that we've actually had it where we've had 2 different topics on 2 different nights. In this case, there's going to be a session on Monday, September 8th, and on Tuesday, September 9th, 8 p.m. Eastern, 5 p.m. Pacific time. All you have to do is just select save my date here, save my seat here, and select your date and time. Like always with all of our group coachings, this thing is going to sell out fast. It usually sells out in about a day or so. So just go in there and jump in there. Go ahead and save your seat, get the payment selected so you can definitely be in on that webinar. It's going to be talking about a ton of stuff with trade adjustments and obviously some live Q&A at the end. But remember, these things are always limited to just 20 people, so that's it. I'm going to cap it out at 20 people for each. I'm hard and fast about that because I want it to be high quality for you guys. I want you to have an opportunity to ask questions, get answers. I don't want it to be 600 or 700 people in this webinar. I always cap these things out to 20 people. So you got to get over there and sign up. All right, so today we're going to go over all of the trades that we made here on Friday. And these will be all the trades today or on Friday that we made. 2 opening trades and then 1 big adjustment in X. I actually want to go over the adjustment in X, which is US Steel first, because we made that at the end of the day. And it was a little bit different adjustment than we usually make, and really kind of a precursor almost to the webinar and group coaching that we're going to do in the next 8 days. So what we did here with X is that we had a short call spread above that's now well into the money. So X is trading above our short call spread. So let me just go over here to the charts and you can see where X is trading. You'll notice that it's had a really, really huge run higher over the past couple weeks, right? And not to say that I don't think that it could continue higher, but I still remain fairly bearish on this trade. Although at this point, we have to make some adjustments to start adding some premium back into our portfolio, right? We can't just continue to be bearish and the stock just continue to move up. So we had a call spread. Our legs were at 36 and 37 above the market. So we had the 36, 37 above the market. And you can see that this is that position right here on the chart. So this is before we made the adjustment. This is what our position looked like. We had that short call spread. And you'll notice that X, or US Steel, is trading at 38.68. So well into the money. Our short strike is all the way over here at 36. Hasn't lost all of its value just yet, but it's lost a good chunk of its value for what we're actually trying to do. Now, we didn't have an opportunity to sell a put spread because there's just not enough premium to do that. So I want to take you in and kind of walk you through that mentality first of why we didn't sell a put spread against this position. So if we actually did sell a put spread, it would be something like the 36.34. So we would match up the width of the strikes and we do the same number of contracts. So we would match up the 5 contracts here with the 5 that we originally had. The same width of the strikes that we would do would be a 36.35 on the put side. So we would do a 36.35, making it a dollar wide spread. Same as the dollar wide that we had on the top side, which is the 36.37. Now, what's really unfortunate about this right now is that this only trades for about an 18 cent or 13 cent credit right now. So that spread only trades for about 13 cents, meaning that we really don't get a huge reduction in our loss or really not doing ourselves any favors other than reducing our loss by $50. And of course, that's a reduction in our loss, but it really doesn't give us a lot of kind of leverage against the stock to possibly turn a profit in this thing. So what we did instead is we went really close to the market and tried to recenter our trade over the market. You'll notice that our big profit window is down here well below the market. We wanted to shift that higher and move that and recenter it over where the market's trading right now. So what we did to do that mechanically is we sold a strangle, the 38.39 strangle. And you'll notice that we didn't exactly match up the number of strikes, and that's okay. That leaves room to do more of this if we need to. But we kept our put side trade because that's still, or our call side trade because that still gives us a little protection to the downside. But you'll notice now that our profit loss diagram is now centered back over where US Steel is trading. So it's centered back over there and gives us a break even very close to 40. And on the bottom side, really a couple different break evens, but really down around 36 is really where we really start losing some money. So it gives US Steel a little bit more room to run higher, all the way up to about 40, but it also protects us to the downside still to 36 by keeping that call spread intact. So again, we go back visually to the charts, take a look at what this does. So it gives US Steel a little bit more room to run up to about 40, and then protects us all the way down to about 36 for expiration. So a nice little window of opportunity here, again, kind of shifting our window of profit up to meet up with the market. Now, this did require us to go naked on this strategy and this adjustment. And as I continue to preach a lot, and this is a great example of doing this, if you keep your trade size fairly small to begin with, then you have the margin and capacity and account size to then go more aggressive with these trade adjustments. And so I often see a lot of people do this, and I know that you guys have heard me say this a ton of times, where they'll do a trade really, really big. So they'll do 20 strikes or 30 contracts or whatever the case is, and they don't leave themselves any room to make adjustments if it goes bad. Now, if it goes great, they obviously make a good chunk of money, but my opinion is you make the initial trade size very small, not too small that you don't obviously take a profit and make some good money on it, but you make the initial trade size small so that if you need to do something like this, then you can go ahead and do that and use up a little bit more margin to kind of aggressively protect a position like this. Now, we still have a bunch of opportunity here to sell more premium. So we've only done 4 contracts on each side for this strangle. We could easily scale this up to somewhere around 7 to 8 contracts. So just keep that in mind as you're doing this. You don't have to adjust everything at one time. This adjustment that we made in US Steel gave us an opportunity now to make some money in US Steel. And if we need to continue to aggressively protect this position, we will absolutely do so. So one of the big questions that everyone asked is, okay, Kirk, if we made this trade and if it was an account where we can't trade strangles or we don't have the trading level to trade strangles, then what I would say is you want to do something more like a synthetic strangle. So a synthetic strangle would be doing a credit spread very wide on either side. So in the case of the call spread, you might want to do something like selling the 39 and buying the 41 or buying the 42. Now this will take in less premium, so you will have less premium overall because you have to go out here and buy these extra legs, but this is better than doing nothing, right? So my opinion is if you can go out further, buy a cheaper leg somewhere out around 42 or even 43 because it's really cheap protection, then your broker should allow you to do that position because it's just like a credit spread. So same thing on the put side. What you want to do is sell the 38 and then go out to maybe 36 or 35 down below and buy something that's really cheap. Again, on the put side, it's going to reduce your overall credit. But if you don't have that trading level to be able to do short, naked options, then this is the next best thing, is to go very wide on credit spreads on either end, basically making a synthetic strangle. Okay, so that's really the plan here for US Steel. We're going to kind of ride it out for the rest of this week coming up. It's a very short week. We wanted to make this adjustment before the long weekend, hoping to get a couple extra days of time decay. So that's why we kind of waited until the end on Friday to make this adjustment, because now we get 3 days of extra time decay so that when this thing opens up on Monday, hopefully, or on Tuesday, hopefully if there's no adjustment in the trade, we're going to see a nice little contraction in the strangle. Again, it's going to quickly help make some money back on this trade and try to protect this position going forward. So hopefully that was a huge tutorial on that. Again, we're going to talk a lot about making adjustments and kind of the mechanics behind making different types of adjustments in the group coaching webinar that we're doing next week. So make sure you go ahead and sign up for that. All right, so two new opening trades that we did make today. Both of these were vertical call spreads. What we looked at in our portfolios that we found is that we actually need to add a little bit of long delta to our portfolio. So if the market does continue to move higher, not to say that we definitely think it will. I think it's short-term overbought. It could be moving down, but we want to add some positions that take advantage of possibly a move higher in the market. So we did that today or on Friday with AXP, which is American Express, and BAC, which is Bank of America. So for AXP, we did the 87.590 vertical call spread. We paid 140 for that contract. I'll go in here and we can take a look at AXP real quick. So here's the chart of AXP. Starting to move higher nicely, and it could have a lot more room higher if it wants to move up, because it did move so far so fast to the downside in August. As we get further into September, there's really not going to be a lot of selling resistance for this thing until we get into the mid to upper 95 region. So I think that there is a lot more room here in American Express, and if it does continue higher, then we'll obviously take advantage of that. One of the reasons that we decided to go with the strikes that we did is because both of these strikes give us a really, really good break-even point. So you'll notice that with this contract, the vertical spread 87.50 is the first strike that we bought. That's the 87.50 call. Because we paid $1.40 for that, that moves our break-even price to $88.90. And you can see that that's almost $1 below where American Express is trading right now. So very, very good potential on this trade because our break-even price is almost $1 below the market. That gives us an extra wiggle room of $1 in this trade. So I really like the American Express trade. But as always, you guys can see here, I practice what I preach. Keep the trade size small, especially with these debit spreads and calendars, because they're not the high probability type of trade. They're more directional in nature and taking advantage of possibly a move higher in volatility, but always keep these trade sizes small so that you don't over allocate into different trades that are not high probability. Same thing with Bank of America, very similar thing. We did the 15-17 call spread. Because we paid a little over $1 for that call spread, we bought the 15s, sold the 17s against them. That puts our break-even price right at about 16 for Bank of America. Very, very similar thing going on with Bank of America as far as our break-even price. At the time we entered the trade, had really, really good break-even price. We only got about a 9-cent wiggle room here in Bank of America at the end of the day. But again, Bank of America had a nice breakout, starting to stabilize. So we're hoping that it continues to move higher as we head deeper into September and October, but gave ourselves a lot of room to make some money. Because our break-evens at 16, basically draw the line in the sand right here at 16 all the way out to October, and so long as Bank of America trades anywhere above 16 between now and October, we're going to have an opportunity to make some money on this trade. So those are very, very simple debit spreads, very easy trades to make. They don't require a lot of capital. In this case, it was $140 and about $200. So very easy for some of the new beginners and people who have just signed up with us here at Option Alpha. Go ahead and try to make these trades on Tuesday if you missed them on Friday. So as always, I hope you guys really enjoy these video tutorials. Let me know if you have any comments or questions by asking them right below here in the comment section. I'll get back to all of those tonight or tomorrow before the open, and happy trading.